The Strait of Hormuz remains under the spotlight as we move into the second week of April, with escalating tensions threatening a route that carries roughly a fifth of the world's oil. Oil is hovering around $110 a barrel as markets price in the risk of prolonged disruption, while at the same time, gold, which initially rallied, is now slipping and is a bit more volatile. Stronger U.S. economic data, a firmer dollar, and rising bond yields are pushing back expectations of rate cuts. And that's forcing a rethink of the traditional safe haven trade. So instead of a clean move higher, we are seeing something a bit more complex. War driving inflation and inflation tightening financial conditions. Well, Rick Rule has long argued that these moments when markets become confused, when sentiment breaks, these are the times where there are real opportunities emerging. He's the founder and CEO of Rule Investment Media. Rick Rule, thanks very much indeed for talking to us.
A pleasure, sir. Thank you for having me on.
Well, look, we were not short of news this Easter weekend, were we? I mean, the Strait of Hormuz is emerging as a key pressure point for global markets. Rick, when you speak to metal investors right now, how are they digesting all of this? And more importantly, how are you seeing it?
I think one mistake that investors make is that they trade headlines as opposed to perhaps speculate on outcomes over time. Uh, People's actions seem to be very transitory. And I think that probably not enough people pay attention to headlines. As an example, in the header, you talked about the true fact that the Straits of Hormuz is responsible or transits 20% of the world's oil. A deeper look into the headline would reveal that over 50% of the world's export crude transits the Gulf. So the headline itself understates the problem, actually. And I think that's indicative of the way that we react to the news that we consume, as opposed to how we analyze it. A different circumstance around the same question relates to gold. Gold has sold off, it is said, because there has been sellers, which suggests to me that gold exercised its function, which is to say it provided liquidity. As an example, ironically, the U.S. actions in the Gulf created a stampede to safe haven assets, including, ironically, the U.S. dollar, the DXI. The Turks, defending the lira against the dollar, were forced to sell gold. So it's important that when one considers gold in the context of the Gulf, that one understands why gold sold off. Rather than react to the headlines, one needs to anticipate the logical outcomes of actions that are taking place. To the extent, I'm sorry for this long-winded answer, but it was a big question. To the extent that this war continues, it is likely that there will be, if there isn't already, a global economic slowdown. As an example, from a consumer's point of view, high energy prices equals a tax. That's problematic. And traditionally, one must ask themselves, what has been the government response to an economic slowdown? Artificially low interest rates and increased government-sponsored liquidity. And what has traditionally been the asset class that has benefited the most from that? Gold, of course.
Rick, you've built your career on buying what's unloved, let's put it that way. But right now, with volatility across gold, silver, and equities, to you, what specifically today is being mispriced by this thing we call fear?
That is a very hard question. My life has become much more complex since the oil price increase. If you had asked me last year, in the middle of last year, I would have said oil was unloved. Suddenly, of course, neither oil nor gas are unloved. There are a few microsectors. One could say single asset gold producers. I think the price of gold stocks, legitimate gold stocks, below the very, very, very best likely will benefit as a consequence of increased gold prices, and as a part of the fact that there will likely be mergers and acquisition in the space. But really, that's an exception. The truth is, I struggle to find a sector that is really, truly hated. Perhaps the conventional financial services companies worldwide that are beginning to be priced as though there will be a lot of disintermediation from artificial intelligence, but I'm stretching to answer the question. I don't know.
Look, the dollar is holding strong, yields are rising, and rate cuts are being pushed further out, right? In your view, Rick, what matters more for gold from here, the war or the cost of money?
The cost of money, specifically the juxtaposition between the rate of inflation, the real rate of inflation, and the yield available on savings instruments. Gold does well when people are concerned about the destruction of their purchasing power in fiat currency denominated instruments. If, as an American, as an example, you believe that the deterioration of the purchasing power of the US dollar is measured by the CPI, the Consumer Price Index, you aren't too worried. Uh, your dollar, according to the CPI, is going down in value by 2.5% a year. And if you own the US 10-year Treasury, you're getting paid 4.6. In other words, you're getting a real yield. But Devin, if you believe like I believe, that the deterioration of the purchasing power of the US dollar is closer to 8 or 10% per year, then the problem becomes very apparent. You aren't getting paid 4.6, you're losing 3.4, which is to say you are experiencing a negative real uh, interest rate after inflation. It is precisely that circumstance, a negative real yield on savings instruments, that drove gold during the decade of the 70s. One must remember that, according to the U.S. Then Office of Management and Budget, the U.S. dollar lost 75% of its purchasing power in the decade of the 70s. The interest rates available on savings were far below that number. And the consequence was that people ultimately shifted their savings from conventional savings instruments like US Treasuries to what had traditionally been more secure instruments in periods of inflation, which is to say, gold. I think that past is prologue in this case.
I want to shift spotlight now onto another metal, Rick. You sold a large portion of your silver before this correction, right? Was that purely an evaluation or valuation call, or do you think silver's next move depends on something fundamentally changing in the macro environment?
That was a personal decision, not reflecting macroeconomics so much as reflecting the fact that my physical silver was a speculative position for me. I regard gold as a savings instrument, and I regarded silver as a speculation. I bought the silver during a period when silver was really, truly unloved. And I thought that if silver passed from being hated to being even tolerated, never mind loved, that the silver price would do well. That came to pass, and silver did very well. And I looked at the role that silver occupied in my own portfolio, which is to say speculation, and I asked myself whether I considered the juxtaposition of risk to reward in silver to be the best available for me as a speculator. And the arithmetic became fairly clear. Silver stocks were a better speculation than silver. If the silver price increased, the silver stocks would do well. If the silver price stayed the same, then by definition, I'd make no money on the silver. But the silver stocks are being valued in the market, discounting silver down to $45. So, in a sideways silver market, the silver stocks could still do well, but silver wouldn't do well. And ironically, in a down silver market, the discount that the silver stocks were enjoying, if that's the right phrase, relative to silver, meant that I likely had less downside in the silver stocks than I had in stocks. So 50% of the money that I realized from buying my silver went into silver stocks. 25% went into savings, which is to say physical gold and very short-term U.S. Treasuries, and 25% of the money went into oil and gas stocks. Not anticipating war, by the way, but rather because I felt that the oil and gas stocks were undervalued relative to where I saw oil and gas prices being, I hasten to say, in 2028 or 2029, not 2026. I was not clairvoyant. I didn't anticipate a war.
Yeah. I wonder what the picture is like for copper, Rick. I mean, copper has a strong long-term story around electrification and supply constraints, right? But here's the question. If this conflict slows global growth, does copper get delayed, even if that thesis is correct? What's your take on that?
You're seeing that right now.
Yeah.
Two things are happening. There was a lot of speculation in copper, and a lot of the commodity speculators were speculating with borrowed money, and their carry costs just went up. Interest rates are rising everywhere, so it became more expensive to hold the copper. At the same time, we're experiencing, it would appear to me, a synchronized global economic slowdown, which is to say the near-term needs for copper, as you so rightly explained, are being constrained by an economic decline. Looking further out, if we assume that we don't descend into a global depression as opposed to recession, I'm no economist, so I won't opine on that. There is zero doubt in anyone's mind that 30 decades of underinvestment in copper, 3 decades of underinvestment in copper, will result in supply shortfalls. Assuming that demand over 5 years doesn't grow, the truth is that we will not be able to maintain current levels of production, and we'll have to ration by price. It is important to know that you can't make up for 30 years of misinvestment and malinvestment by 5 years of new investment. That's not the way the copper works. Not the way the market works. So almost no matter what we do, save a synchronized global depression, copper demand will continue to increase, and copper supplies are on an inexorable decrease. And there's not much that anybody can do about that. I was recently re-listening to some of the recordings from Mining Week in London, where the largest copper mining companies in the world said that they need to spend $250 billion constant 2025 dollars, uninflated dollars, to maintain current levels of production, which they noted doesn't take into account the fact that we're already operating in a deficit and that copper demand is increasing by 2% compounded. That's a very interesting statement, and I don't know how we get around as a species that dichotomy. I just don't know how we do it. It is more concerning, perhaps, that the industry's estimate of the increase in inputs around construction is about 8% compounded, which means that $250 billion grows 8% per year compounded. This is a very interesting problem.
Yeah, well, that's copper. Now, in a moment, Rick, I want to get your view on how energy and oil impacts on all of this. But first, here's your Mining Minute. You're watching the Mining.com Minute, a spotlight on a headline story. Barrick Mining is hitting the brakes on its giant Reko Diq copper-gold project in Pakistan, warning that rising security risks and the Iran war are clouding the outlook. That is a major setback for one of the world's biggest undeveloped copper deposits and a project seen as crucial to Barrick's future growth. The company says it will stretch its review by another 12 months from July as it rethinks spending and geopolitical risk. Reko Diq had been penciled in for the first production in 2028. Now, with phase 1 alone carrying a price tag of more than $5.6 billion. Once up and running, the mine is expected to throw off tens of billions in cash over nearly 4 decades. Watch out for more headlines on Mining.com Minute. I'm Devin Murgan. Well, Rick Rule is with us. Rick, you've said energy is underinvested. Now, with oil back above $110 and supply routes under pressure, is energy actually the cleanest expression of this crisis, more than gold?
Well, I think that may end up being the case. When I say energy is underinvested, what I mean to say is that for the last about 4 years, on a global basis, the oil industry, importantly, including state controlled firms, has been underinvesting between $1 billion and $2 billion per day in sustaining capital investments. Now, these are things like drilling makeup wells in shale plays or recompleting wells, things like that. The not new project investments, but sustaining capital investments. What's necessary to maintain your producing base. This doesn't necessarily impact output in year one or year two. Years 3, 4, and 5, these problems are cumulative and compounding. Two examples. The industry grievously underinvested during the COVID period. The consequence of that is that the oil price, which had fallen all the way to zero, but stabilized at about $20 a barrel, didn't merely recover to $60 or $70, the number that was required for the industry to earn their cost of capital and pay their taxes. It recovered to $85 or $90. It overshot to the upside because until the lag in sustaining capital could be met, there were production decreases. A different example would be the two state-owned oil companies, PDVSA, the Venezuelan company, and Pemex, the Mexican company, which have for decades underinvested in support of politically inspired domestic spending programs. Despite both of these countries having enormous reserves, Venezuela is the largest in the world, the state-owned oil company, PDVSA, has experienced an 85% production decline. The impact of deferring sustaining capital and new project investment is cumulative and compounding, and it gets ugly in the out years. Mercifully, in the U.S. and Canada, as an outcome, perhaps, of the new pricing levels experienced as a consequence of the Persian Gulf, sustaining capital investments are soaring. And at least on a continental basis in North America, the sin of 2023 and 2024 and 2025 is not being repeated in 2026. The rig count is exploding. Demand for recompletions is exploding. So at least in this hemisphere, in this continent, the sins of the earlier part of this decade are being corrected.
Mm. Rick, listen, it's been a debate since gold started really taking off, right? I mean, a couple of months, a year or two ago. This whole metal versus the equity stock here, right? Even with elevated metal prices, mining equities haven't fully responded. Is that a buying opportunity, or is the market correctly pricing in higher costs, maybe political risk and capital constraints? How are you seeing this right now?
I think that depends on the investor.
Yep.
I consider them to be two separate but related asset classes. For me personally, in my own portfolio, gold itself is a savings asset. It's a form of liquidity, and it's a form of insurance. Gold is different, or the gold stocks, pardon me. The gold stocks to me are an investment. I take some risk of poor corporate performance, but if I'm right, if I select correctly, I magnify the benefit of margin increase. The smaller gold stocks, I would define as more speculative. In other words, more speculation than investment. So I think in terms of the individual portfolio, the individual investor needs to decide where in their portfolio they need to bolster. Do they need more savings and liquidity? Can they not afford to take risk? If so, you own the bullion. If there's a portion of your portfolio where you're willing to take more risk, but moderate risk, in return for greater reward, and you're willing to do some work, if you're willing to absorb the risk of corporate failure, then you can buy the high quality gold stocks. If you're willing to work hard, if you're willing to do securities analysis, and if you are willing to assume both volatility and absolute company risk, then you can speculate on the smaller gold stocks. But there isn't a one size fits all answer. The answer really is a function of individual portfolio planning and one's tolerance for risk, as well as one's reward horizon.
Rick, I've got just almost wrapping up, but I've got to get your sense and your response to this. We've spoken to experts, some of them which say, and there are those out there, gold has peaked. What's your knee-jerk response to that?
I hope they're right. Gold traditionally does well when other aspects of the economy do poorly. And at 73 years of age, I'd rather be wrong about gold and right about my life. I think, however, that I'm wrong. I think that gold reflects concern about the maintenance of one's purchasing power in fiat currency denominated savings instruments. And I believe that that outlook is challenged at best. In my country, in the United States, our on balance sheet liabilities now exceed $39 trillion, 33 trillion net of the Fed's own balance sheet. The Congressional Budget Office estimates that the net present value of off balance sheet liabilities, which is to say unfunded entitlement promises, exceeds 120 trillion. If you add those two numbers together, 120, and let's round it up to 40, $160 trillion, that's a very large number. It's a particularly large number when you juxtapose that with the Internal Revenue Service estimate of the private aggregate net worth of Americans, which is $170 trillion. If you take that $170 trillion number as the positive, and you take the $160 trillion as the number, what you see is a $10 trillion margin between what America owes publicly, just at the federal level, and what we're worth in aggregate. And that itself discounts the fact that the on-balance sheet liabilities are growing at $2 trillion a year before the war. And the increase in the unfunded entitlement liabilities is increasing at $2 trillion a year. Now, how do we get out of this circumstance? Well, we could do what the Argentines did and have an honest default. Say to the bondholders, too bad, so sad. Yes, we borrowed, and yes, you're getting screwed. And by the way, we could say to the entitlement beneficiaries, old fat bald guys like Rick Rule, yes, we know you paid in for 60 years, but we don't have any money, so we can't send it to you. I don't think that's the American way. I think we have a dishonest default. I think we inflate away the net present value of the obligation, and we balance the budget in that fashion. We did this, by we, I mean the United States, in the decade of the 1970s. In the 1970s, we, according to our own government, reduced the purchasing power of the US dollar by 75%. Not to be forgotten, the gold price during that period of time increased 26-fold. I'm not suggesting to you that the gold price increases 26-fold. I'm suggesting to you that if history rhymes, gold will maintain its nominal US dollar purchasing power while the US dollar loses 75% of its purchasing power. Ergo, to some, perhaps not linear degree, the increase in the gold price, the nominal gold price, will mirror the decrease in the purchasing power of the US dollar. I certainly hope those who believe that the gold has peaked are right. I certainly hope I'm wrong. The circumstance that I describe will be troubling for tens of millions of people on fixed incomes and people who have inadequate savings to maintain their standard of living in a decade where I believe their purchasing power declines by 75%. I would love to be wrong.
Now, I hear you on that one. And so we wrap up, Rick. Given everything we've discussed, war risk, inflation pressure, higher rates, and volatile metals, where are you putting fresh money today?
I am building liquidity myself in very, very, very short-term U.S. government instruments. I regard the fact that the yield I get is not sufficient to avoid destroying capital, but I believe that the negative real interest rate in the short term is an option premium that I pay for having liquidity. I believe that the whole set of circumstances in front of us increases the possibility, not the probability, but the possibility of a liquidity squeeze, a la 2008. I also own, relative to the size of my portfolio, a lot of physical gold, which I consider to be insurance. I hope I'm wrong. If I'm not, I suspect that gold will come in handy. I am buying the very, very high quality gold producers. In this case, limited in my mind to Franco-Nevada, Wheaton Precious, and Agnico Eagle, because I have a portion of my portfolio that is an investment as opposed to speculative portfolio. And I have a list of 42 or 43 smaller gold producers that I believe if the market doesn't reward them, will be taken over in a strategic fashion by other larger companies. I also, and this probably isn't much use to your listeners, but I am investing in several small, well-run, very solvent community banks in the U.S. Banks that don't have big commercial real estate portfolios, banks that don't have big consumer lending, i.e., credit card portfolios, rather banks that can expand their market share in a circumstance where credit gets tight. This is probably not appropriate for folks at home. I've spent 45 years understanding how banking works, and it's probably a sector that I am better able to invest in than many others are. But you asked me the question, so I gave you the answer.
No, it certainly does sound intriguing. The founder and CEO of Rule Investment Media, Rick Rule, it's a pleasure. Thanks very much indeed for chatting to us.
A pleasure. Thank you for having me on.